All right, you guys. So, in order to understand what's happening in the market right now, you have to understand what a bond is. And imagine that you have a walkway, a brick walkway out front of your house, and everything that you see over here, all these individual stocks, Bitcoin, the dollar, even the British pound, the entire index of the SPY, those are all like the bricks, right? And they can move up and down, and they will, but no one takes notice of what's making that a smooth path. You know, if you just put a brick walkway down on the ground, it would be all bumpy. So what they do is they lay a substrate, and that substrate is the bonds in this case. So the bonds are not something that anybody takes notice of because they're supposed to be stable. And so it's really important to understand what we're seeing here with the bond market poses systemic risk to the entire system. And because the foundations, the underpinnings of all these other assets have everything to do with bonds on the foundation they're laid on. And so this is the 20-year Treasury ETF, and it goes back to its inception, in 2002, and we could go back further, but for these purposes, this is enough. And so the thing to take note of is that in the past, when we had the Corona crash, which is right here, what happened was people rotated into the safety of the bonds. That's why the ETF, that's why you see this big spike. And I played that spike, and I was able to hit, in some cases, 1,000 or 2,000% on call options. And so anticipating the move on the SPY, because the SPY had sold off in 2020 at the collapse, what we did is we entered into call options knowing that people would rotate into safe haven. All right. So where we're at today and why it's something that's really important is that as of today, the bond market has broken to what I would call systemic risk areas. We're moving into a new monetary system. That's what this is showing you. And so when we look at this chart, if you go back to this range here, and as somebody who watches this stuff regularly, I have this all memorized. It's around 104.53, and then you've got this other when you break 100. And so anyone who's paying attention knows that this 104 is a big support for bonds. And so that means that people aren't willing to sell this cheap. And that's what essentially a support is that no longer are there sellers, there's buyers, which drives the cost up. There's a less supply. And so that happens with trading all the time, and there's all these support and resistances. But this one in particular is a historic and very big one. And so you can see going back to we were here in 08, and now in 09, and then we were here in 2010, and so this has a lot of support in this range here for TLT. I hope that's making sense. Historically, these are monthly candles, okay? So this is a lot of support in this area, and you even have the support here in 2013. Okay, so also you just not knowing about charts, what do you notice that's different? You see this? Now, what you would expect as a buyer of the ETF is I would enter here because we are at support. It's a very safe bet. The bond market's supposed to be very safe. Or I would enter here expecting a bounce. Okay, that would be the expectation. That would be normal. Now, what happened today is that we broke below, we broke below the historic support. We're down to 94.90, 94.88 on TLT. Okay. So along with that, let me just show you the daily. So let's look at the daily, and that will kind of give us some idea. So what I want you to see here is that the stock market is holding these levels while the bond market continues downwards. This is a divergence. Okay, so the word for that is divergence. You want to know that word because what we're seeing is you see how this broke a key level and it continues down, and this, I'm not exaggerating when I say that this is a systemic risk. Essentially, there's no buyers of the bonds. The way that the monetary system works and holds itself up is that there has to be somebody to buy these bonds. And what we're seeing here is a lack of liquidity in the U.S. Treasury market, which means that there's going to be lack of liquidity in other Treasury markets. And if you know anything about what happened in Europe lately, their monetary collapse, a lot of it have had to do with their Treasury market. And so what I want to point out is that you're seeing a divergence. You saw this move in a bottoming pattern on the SPY, yet you're seeing a very significant, and not being alarmist, but this is a scary drop in U.S. bonds in let's just 1, 2, 3, 4, 5 days here. You're 5% down. So what that means is that either some institution like a large bank, like a JP Morgan, so all of the pensions, that one of those blocks on the sidewalk is pensions and IRAs, and like they kind of keep people invested in these things, which holds the market up. All right. And so a little bit more complex concept, but something to grasp is that one of these bricks that I'm talking about are pensions and IRAs. So the majority of Americans pay into a pension, or they have an IRA, a retirement. Okay. And I said this in October of last year to the wall. No one listened. And I said I would pay the penalty on my IRA and take my money out, because what they did was they leveraged. So IRAs and pensions are required by law to hold X amount of what they call high liquidity, high quality assets. Okay. So they're required by law to hold bonds and or cash as part of that pension account. But the other part of the account, what they did was they used derivatives like options, which are extremely risky. So the pensions, knowing that, and I know what was possible, the idea being that your pension is leveraged on options contracts. When that is going well, everybody's happy. But if something systemic happens, the entire pension system collapses, and no one but my dog understood what I was talking about. But that's exactly what happened in the UK recently, and it's exactly the risk that we're going to face here. So it's too late. If you have a pension fund, you're too late now. But so what this shows us is that a country, so this size move is due to either institutional money, or a country like China or Japan selling out of the bonds, liquidating, okay, because they need cash. They're converting into cash. could also mean that somewhere out there, they're aware that there is systemic risk to the U.S. Treasury market, and so they want to get out, which is even a scarier thought. So today, as you look at this divergence in the bond market to the S&P, the outcome of that, and this is why I'm doing this, as people talk about these levels, and recently I've been looking for a bounce in the S&P because we are at this bottom, and some of these patterns are showing up that way, that we should be kind of hitting a bottom. However, right now, due to this movement in bonds, we are really entering into a new monetary system. And so I just want to bring that to your attention and make you aware that if you look at, this is the long-term S&P chart that I have, and I don't often use it, but this pink line goes all the way back, that's why it's such a significant line, to 2008. Okay, and so this line, you see how the S&P trades and just kind of grips to this line. It maybe comes down, comes back up, goes above, and then we have this giant bubble. That's the inflation bubble, the money that was the quantitative easing, and now we're back to this line. If we break that line in a convincing way and the bond market does not recover, there's this blue line here. Okay, this is a new trend line that was established during the COVID crash. And if you look at the retracement on that, it's going to be about 20, that's 40%, which would put you at 60% down, right? Which is exactly what Dow theory says, that a full retracement is 60%. And the way that could happen is, and it could happen quickly, it's the kind of thing that you would, like an iceberg, the bonds are like an iceberg, or like that ground. Everything's really wobbling now. And one morning you walk outside and it's like, holy shit, where'd the sidewalk go? Right? That's what we're seeing here. And so anyway, that's a little bit about the bond market. That's how important it is. And we shouldn't be here at all. This territory here, I've watched all the videos about pull your money out of the bank, and I understand these people that are like buy gold, and it's always, you know, the world is ending, and that's not my speed, because I understand that these levels hold and you get these crazy bounces and things happen that we don't understand as a common person. You look at it like, how are people buying stock? Well, it's a lot more complicated than people think, you know, as to why these moves happen. But seeing this, it has the evidence. What we have is evidence that the substrate on which everything here is built on is shifting. And so the way that could play out is two ways. If this continues down, we don't want to see that. You really don't want to see that. But essentially what this means is, if we don't get a rebound, if you stay stuck here, or you flush out, and God forbid you come down to something like this, if you come down to here, it'll be a whole different, the monetary system has collapsed. That's how close, this is, I guess, my point. You're close enough right now on today. It wasn't yesterday. You know what I'm saying? I'm not saying this based on like some theory that somebody gave me. I'm reporting to you in real time the news of today. You just came into this level today. Okay? So if you continue to get a flush, and you flush through this level, 88.85 on the bonds, the world economy is monetary systems around the world are going to collapse. There's nothing conspiratorial or statistically untrue about that. That's the way it works. That's the substrate. The substrate of the of the walkway would be washed out, and all of the bricks that are in here, they're all going to shift into their own positions, and certain ones will get more wrecked than others. But that's what we're looking at today. This is a very surprising move. I follow a few traders that are super dialed in. I don't watch any YouTube because I understand more than 99% of the YouTubers. The people I listen to are, they're macroeconomics. They're things that bore people. And, you have to have an attention span to listen to someone talk for, an hour and a half about something like a bond to understand what I'm talking about here. But you broke below this key level, and hopefully you start to see some traction or movement upwards. If you do not, it's too late now anyway, guys. So, I mean, to save yourself from this, if you haven't prepared, it's too late. That's what today tells me as well. And what you could have done, should have done, is followed along with this, because I'll show you as this collapses. I've been talking about building these ETF positions, and on all of these plays, I'm probably up a minimum of 30% in this whole thing. And I know some of them I'm probably up about 100%, maybe more. I think on one I'm up 150%. So anyway, that's what's up, guys. Today was a big move in the bonds, and it's nothing anybody wants to see, but we have some statistical evidence that there is a shift in the foundation of what creates currency. All right, peace.